Most people do not avoid investing because they are lazy. A lot of people avoid investing because they are waiting for the moment when it finally feels safe. They look at the market near all-time highs, they hear people talk about bubbles, crashes, recessions, and overvalued stocks, and they tell themselves, I'll start when things calm down. But the strange thing about investing is that the moment when it feels safest emotionally is usually not the moment that rewards you the most financially. And that is the trap. Waiting for the next crash can feel responsible. It can feel patient. It can feel like you are being smart and not buying at the top. But for a lot of people, waiting for the perfect dip slowly turns into waiting for months, then years, then an entire decade. And by the time they look back, the prices they were scared of buying at may look cheap compared to where the market eventually went. By the end of this video, I want to help you see investing differently. Not as something where you have to perfectly predict the next crash, call the bottom, and make one perfect decision at the perfect time, but as something you can start small, automate, and build into your life slowly. Because the real goal is not to win every market moment. The real goal is to give time enough room to work. My name is John, and I try to talk about money in a way that is honest, simple, and realistic. Not in a way that pretends investing is always easy, or that everyone has thousands of dollars sitting around ready to throw into the market. Real life is more complicated than that. People have rent, food, debt, car repairs, family responsibilities, and the mental weight of trying to make good decisions when everything already feels expensive. So this is not about shaming anyone for being cautious. It is about understanding when caution quietly turns into inaction. The reason this topic matters right now is because markets being near all-time highs can mess with your head. It can make investing feel backward. You think, why would I buy now? Wouldn't it be smarter to wait until prices come down? And on the surface, that sounds logical. Nobody wants to feel like they started investing right before a drop. Nobody wants to put money in and immediately watch it go down. That feeling is uncomfortable, especially when you worked hard for that money. But this is where most people misunderstand what long-term investing actually is. They think the goal is to avoid ever buying before a decline. But if you invest over decades, you are almost guaranteed to buy before many declines. You will buy before pullbacks, corrections, scary headlines, bad months, and maybe even recessions. That does not mean you failed. That is just part of being an investor. The real question is not, can I avoid every drop? The better question is, can I keep building through enough market cycles that the drops stop controlling my entire plan? The market has always had scary moments. There have been crashes, bubbles, recessions, inflation scares, banking problems, wars, rate hikes, layoffs, and endless headlines telling people why now is not the right time. And yet, when you zoom out over long periods, many of the all-time highs that once looked expensive eventually became old prices people wish they could buy again. Think about someone looking at the market in 2005 and saying, "It is too high. I'll wait for a better entry." In the short term, they may have had reasons to be nervous. But decades later, many of those prices look completely different in hindsight. That does not mean the market goes up in a straight line. It does not mean crashes are impossible. It does not mean every investment is safe. But it does show something important about human psychology. We tend to judge today's price by today's fear. We imagine the next few weeks or months, not the next 20 or 30 years. And because the future is uncertain, we wait for confidence. But investing rarely gives you full confidence before it rewards you. It usually asks you to act with a reasonable plan while still feeling some uncertainty. The hard part is that waiting feels emotionally clean. If you do nothing, you do not have to feel the pain of being wrong yet. Your account does not go down because you never bought. You can tell yourself you are still being strategic. You are still watching. You are still preparing. But doing nothing has a cost too. It is just harder to see because it does not show up as a red number in your brokerage account. It shows up as missed years, missed contributions, missed compounding, and a habit of always needing the future to look perfect before you take action. And this is the part nobody really explains. The fear of buying at the top is not only about money, it is about regret. People are afraid of feeling stupid. They are afraid of finally starting, seeing the market drop and thinking, Of course, this happened right when I got in. That feeling can be powerful enough to keep someone on the sidelines for years. But the irony is that trying to avoid regret can create an even bigger regret later. The regret of never starting. Long-term investing is not built around the fantasy that you will always feel good when you invest. It is built around the understanding that emotions are unreliable in the short term. When the market is high, you feel like you missed it. When the market crashes, you feel like it might keep crashing. When the market recovers, you feel like you should have bought earlier. There is almost always a reason to hesitate. So if your plan depends on feeling perfectly comfortable, the plan may never actually begin. This is where dollar cost averaging becomes powerful. Dollar cost averaging simply means investing a set amount on a regular schedule, no matter what the market is doing. Maybe that is every week, every 2 weeks, or every month. The point is not that this strategy magically guarantees the highest possible return. The point is that it removes some of the emotional pressure from investing. Instead of asking, "Is today the perfect day to invest?" you are asking, "Can I stay consistent with a plan that makes sense for my life?" That sounds simple, but emotionally, it is a big shift. Because now you are no longer trying to win one perfect moment. You are spreading your decisions across time. Some of your investments will happen when prices are high. Some will happen when prices are lower. Some will look good quickly. Some may look bad for a while. But the habit keeps going. And that habit matters more than most people realize. Over a long enough period, consistency can become more important than the exact day you started. And this is why automation is so underrated. When you automate your investments, you reduce the number of times your emotions get to vote. You do not have to wake up every payday and debate whether the market looks too high, whether the news feels too scary, or whether you should wait another week. The money moves according to the plan you already chose when you were thinking clearly. It turns investing from a dramatic decision into a normal part of your financial routine. This matters because real life is not lived inside a spreadsheet. Most people are not sitting around calmly analyzing long-term market data every Friday morning. They are tired after work. They are checking bills. They are thinking about groceries, gas, rent, subscriptions, car maintenance, family needs, and whatever unexpected expense just showed up. When life already feels full, investing can easily become one more decision that gets delayed. Automation helps because it makes the good decision happen before your stress talks you out of it. But there is another reason automation helps, and it is more psychological than mathematical. It helps you build identity. Instead of seeing yourself as someone who is thinking about investing someday, you start becoming someone who invests regularly. Even if the amount is small, that shift matters. A person investing $25 or $50 consistently is doing something very different from a person waiting for the perfect moment with $0 invested. One person is building the muscle. The other person is still waiting for the weather to be perfect before taking the first step. And I know some people here start small and feel like it does not matter. They think, what is the point of investing a little bit? It is not going to make me rich. But that mindset can keep people stuck. Starting small is not only about the dollar amount, it is about proving to yourself that you can begin. It is about lowering the emotional barrier. It is about creating a system that can grow later. A small automatic investment today can become a larger automatic investment when your income improves, when debt goes down, or when your budget has more room. The mistake is thinking that investing only counts when it feels impressive. But most wealth building does not feel impressive in the moment. It usually feels boring. It looks like ordinary contributions made over and over again while life continues in the background. You go to work, pay your bills, handle responsibilities, and quietly keep buying pieces of the market. There is no dramatic music, there is no perfect entry. There is just the slow transfer of money from short-term spending into long-term ownership. And this is where history becomes useful, not because it predicts every detail of the future, but because it helps us think more clearly. Markets have reached all-time highs many times before. At the time, those highs often felt scary because people were comparing the price to the past. But decades later, many of those same highs looked small because the economy, corporate earnings, productivity, inflation, and time changed the scale. What once looked expensive can later look ordinary. What once felt like the top can later become just another point on a long chart. That does not mean you should throw all your money into the market without thinking. It does not mean you should ignore emergency savings, debt, or your personal situation. If you need money soon, the stock market may not be the right place for that money. If you do not have any cushion at all, building some savings can matter before investing aggressively. But if we are talking about long-term money, money you do not need for years, then waiting forever for the perfect crash can become its own kind of risk. There is market risk, which everyone talks about. That is the risk of investing and seeing prices fall. But there is also the risk of never starting. There is the risk of holding cash for years while prices rise. Inflation slowly weakens purchasing power, and your future self receives less help from your current self. That risk feels quieter because it does not show up as a sudden drop. But it is real. Sometimes the danger is not losing money quickly. Sometimes the danger is letting time pass without putting it to work. The reason this matters is not just the number in an account. It is what that number can represent later. More flexibility, more options. More ability to handle life without panicking. More room to choose. Investing is not just about becoming rich in some flashy way. For a lot of people, it is about slowly building a future where every decision is not controlled by the next paycheck. It is about creating a little more distance between you and financial pressure. And that is why waiting for a crash can be so emotionally costly. Because while you wait, life keeps moving. Rent keeps coming. Groceries keep changing. Cars keep needing repairs. Work keeps demanding energy. And the future keeps getting closer. The money decisions you delay do not stay frozen in time. They either become habits that help you, or they become decisions your future self has to make under even more pressure. A lot of people imagine the perfect investing moment as a calm, obvious opportunity. They picture the market dropping, everyone agreeing it is a bargain, and themselves confidently buying at the bottom. But real crashes usually do not feel like sales. They feel like fear. They come with headlines that make people question whether things are different this time. People lose jobs. Businesses struggle. Retirement accounts fall. Friends and family tell you to be careful. The emotional environment that creates low prices is often the same environment that makes it hardest to buy. So when someone says, "I'll just wait for the crash," the real question is, will they actually invest during the crash? Or will they wait for it to drop more? Will they feel confident when everyone else is scared? Will they have cash available, emotional stability, and a clear plan? Some people can do that, but many people cannot, because the same fear that keeps them from buying at all-time highs also keeps them from buying during declines. The reason changes, but the behavior stays the same. When the market is high, the fear says, "It is too late." When the market drops, the fear says, "It is too dangerous." When it recovers, the fear says, "I missed it again." That cycle can repeat for years if there is no system in place. This is why a simple automatic investing plan can be so valuable. It does not require you to become emotionless. It just keeps your emotions from being in charge of every decision. Here's what this actually means in real life. Instead of waiting until you have the perfect lump sum and the perfect market conditions, you can choose an amount that fits your budget and invest it on a schedule. It could be small at first. The amount should not make your life unstable or force you to ignore basic needs. But once it is set, you let the system work. You can increase it later when it makes sense. The goal is not intensity. The goal is consistency. And for many people, consistency becomes easier when it happens right after they get paid. If you wait until the end of the month to invest whatever is left, there may be nothing left. Not because you are irresponsible, but because life has a way of absorbing money that has no assignment. Automating an investment near payday turns it into a priority before the money disappears into random expenses. It does not have to be extreme. It just has to be intentional. This is also where long-term investing becomes more peaceful. You stop checking the market like every movement is a personal judgment. A down day is not proof that you made a mistake. A new high is not proof that you should stop forever. A correction is not automatically a disaster. It is all part of the environment your plan was built to survive. When your time horizon is measured in decades, the daily noise loses some of its power. But that only happens when you understand what you own and why you own it. If you are investing in broad market funds or diversified investments for the long term, you are not just making a bet on one random price point. You are participating in the growth of businesses over time. There will be periods where that growth looks messy, disappointing, or scary. But the basic idea is that ownership, held patiently over long periods, has historically been one of the main ways ordinary people build wealth. Of course, none of this means every investment is good or every strategy is smart. Chasing hype, buying things you do not understand, or investing money you need next month can create real problems. Long-term investing works best when it is connected to a stable plan. That might include having some emergency savings, keeping high-interest debt under control, understanding your risk tolerance, and choosing investments that match your time horizon. This is not about blindly buying anything. It is about not letting the fear of imperfect timing stop you from building a reasonable future. The deeper mindset shift is this: the market does not need you to be perfect. It needs you to be consistent enough for long enough. That sounds almost too simple, but simple does not mean easy. It is emotionally hard to keep investing when prices are high because you feel like you are overpaying. It is emotionally hard to keep investing when prices are low because you feel like something is wrong. And it is emotionally hard to keep investing when life gets busy because the future feels less urgent than the problems in front of you. That is why your system matters more than your mood. Your mood will change with headlines, prices, stress, and whatever is happening in your personal life. But a system can keep moving through all of that. A system says, I invest this amount on this schedule into these long-term investments because I am building for a future that is bigger than this week's market headline. That kind of clarity can make investing feel less like gambling and more like a habit. And once you see it that way, all-time highs start to feel different. They are not automatically a reason to panic. They are also not a guarantee that everything is safe. They are simply part of the market's long-term journey. If the market grows over time, then all-time highs are not rare accidents. They are something you should expect to see again and again. The problem is that each new high feels expensive in the present, even though many old highs look cheap in hindsight. This is why looking backward can be humbling. Imagine someone years ago refusing to invest because the market had already climbed too much. At the time, their fear probably felt reasonable. They could point to real problems, real risks, and real uncertainty. But if they stayed out forever, the issue was not that they were cautious for a few months. The issue was that caution became their identity. They became someone who always needed a better time, and that better time never felt good enough when it arrived. The goal is not to eliminate caution. Caution is useful. It can stop you from taking reckless risks. It can remind you to keep cash for emergencies and avoid investing money you cannot afford to lose in the short term. But caution becomes harmful when it turns into permanent hesitation. There is a difference between making a thoughtful plan and using uncertainty as a reason to never begin. So practically, what should someone do with this idea? The first step is to separate short-term money from long-term money. Money for rent, bills, upcoming expenses, and emergencies should not be treated the same as money meant for 10, 20, or 30 years from now. That distinction matters because it keeps you from panicking when long-term investments move around. If the money has a long time horizon, short-term volatility becomes less of an emergency and more of an expected part of the process. The next step is to choose an amount that is realistic enough to continue. This is important because people often create plans based on motivation instead of real life. They decide to invest a large amount, feel good for a few weeks, then stop when expenses hit. A smaller plan that survives is usually better than a perfect plan that collapses. You can always increase the amount later. The habit is the foundation. Then automate it. Make the investment happen on a schedule so you are not forced to emotionally redecide every time. Automation does not mean you never review your finances. It just means the default is progress, not delay. You can still check in, adjust, rebalance, or change the amount when your life changes. But you are no longer relying on perfect timing or perfect motivation to keep going. And finally, expect discomfort. This may sound strange, but it is important. If you start investing and the market drops, that does not automatically mean you did something wrong. If you start investing and the market keeps going up, that does not mean you should wait for a crash before adding more. Discomfort is part of the process because uncertainty is part of investing. The goal is not to avoid every uncomfortable feeling. The goal is to build a plan that can keep working while those feelings come and go. The turning point is realizing that waiting for the perfect dip is often not a strategy. Sometimes it is just fear wearing a responsible outfit. It sounds disciplined, but it can quietly keep you from taking the exact action that would help your future self. Starting small, automating, and dollar-cost averaging may not feel exciting. But that is the point. It lowers the emotional temperature. It makes investing something you can actually live with. Because the best investing plan for most people is not the one that sounds the smartest in a debate. It is the one they can actually follow through good markets, bad markets, boring markets, and confusing markets. If a plan only works when you feel confident, it may fail at the exact moments you need it most. But if a plan is simple enough to keep going when life is busy and markets are uncertain, it has a much better chance of lasting. And this is what I wish more people understood. You do not need to know exactly what the market will do next month to start building wealth over decades. You do not need to perfectly predict the next crash. You do not need to wait until every expert agrees that now is the obvious time. You need a reasonable plan, a long-term mindset, and enough consistency to let time do what time does. Years from now, the question may not be whether you started at the perfect price. The question may be whether you started at all. Because when you look back over a long enough timeline, the exact entry point often matters less than the years you gave your money to compound. The earlier contributions may not feel powerful at first, but they are the ones that get the most time. And time is the part of investing you cannot go back and create later. So if the market being near all-time highs has made you feel frozen, you are not alone. That fear makes sense. Nobody wants to buy right before a drop. Nobody wants to feel like they made the wrong move. But long-term investing is not about avoiding every bad month. It is about building a life where your future is not completely dependent on perfect timing. Start small if you need to. Automate it if you can. Dollar-cost average with an amount that fits your real life. Keep learning, keep your expectations realistic, and remember that progress does not have to be dramatic to matter. Sometimes the quiet decision you make consistently is the one your future self is most grateful for. And if this video helped you see investing at all-time highs a little differently, you can like the video so more people can find it. If you want more calm, honest conversations about money, investing, and building a life with more breathing room, you can subscribe. And in the comments, I'd be curious to hear what feels harder for you. Starting when the market feels too high, or continuing when the market starts to fall.